This might be the most dangerous turning point after 8 months of pain, because what just happened in the market is forcing one question. Either Peter Schiff is finally being proven right, or Michael Saylor is about to look like a genius again after a 32% explosion. And the scary part? Both cannot be right. One of them is sitting on the right side of history right now, and one of them, despite sounding completely convincing, is about to be catastrophically wrong. The market doesn't care which one you believe. It only cares which one is correct. And right now, after 8 months of silence, pain, and slow financial bleeding, the answer is starting to surface. Stay with me until around the 13-minute mark, because what I show you there reframes this entire story in a way that most people are not going to see coming. Before we go any further, nothing in this video is financial advice. This is analysis, education, and honest breakdown of a situation that is actively unfolding. Always do your own research. Always consult a professional before making any financial decisions. To understand what just happened, you need to feel where we just came from, not just intellectually, emotionally, because the numbers alone don't capture what 8 months of sustained decline does to investor psychology. Strategy, the company formerly known as MicroStrategy, spent 8 consecutive months getting sold, not correcting, not consolidating, not pausing to breathe, selling, month after month after month. And this wasn't just a company declining, this was a belief system declining. Because strategy isn't like most companies. It doesn't primarily make money by selling a product or scaling a service. Its entire financial identity, its entire market thesis, is built around one thing: Bitcoin accumulation. So when strategy's stock bleeds for 8 consecutive months, you're not just watching a company decline. You're watching the market pass a sustained judgment on the entire philosophy behind it. And the market was saying, loudly, consistently, for nearly 3/4 of a year, that it wasn't convinced. Now, let's be specific about who was leaving. First came the cautious investors, the ones who had bought in with moderate conviction and had a real pain threshold. When the first few red months came, they reassessed, decided the risk wasn't worth holding, and quietly exited. Then came the narrative traders, the people who were invested in the story, not the fundamentals. When the story stopped generating momentum, they moved on to wherever the momentum was. And then, most significantly, came the retail investors, the everyday people who had heard about strategy during the excitement, who had bought in because the numbers were going up, who had no deep fundamental thesis, only the belief that the trend would continue. By the time those retail investors finished exiting, the stock was already deeply wounded. But here's what most people don't realize about that kind of prolonged exit. When the people who want out are finally out, something changes underneath the surface. And then April arrived. 32.57%, 1 month. After 8 months of red, one single month of green that was so strong, so decisive, that the word started spreading almost instantly across financial media, across social platforms, across investing communities. Turning point. People said it like they were certain, but were they? That's the first question I want you to hold in your mind right now, because we're going to answer it, but not yet. Because before we get there, we need to understand the war that's been happening underneath this entire price story. What time is it where you are right now, and what are you doing? Drop it in the comments. I'm always curious who's watching and when, whether it's early morning with coffee or midnight when you can't sleep. Let me know. Here's the part that most financial channels are not covering properly. They're covering the price action. They're covering the chart. They're running the technical analysis and telling you about support levels and resistance zones. But they're missing the actual story. Because underneath this price move, underneath these 8 months of pain and this single explosive month of recovery, there is a war happening. Not a market war, an ideological war. A fundamental disagreement about what value is, how wealth works, and which side of this moment history is going to remember as visionary, and which side it is going to remember as a cautionary tale. And this war has 2 very clear representatives. Peter Schiff, one of the most consistent, most vocal, and in many circles most ridiculed voices in traditional finance, has been warning about this for years, not months, years. He called Bitcoin speculative from the beginning. He called leveraged corporate Bitcoin exposure reckless. He called the entire strategy thesis a disaster waiting to happen. And for a long time, particularly during the bull market years, he looked completely out of touch. Then the 8 months happened. And suddenly, Schiff's warnings started sounding less like ideology and more like a prediction coming true in slow motion. On the other side, Michael Saylor, the man who took a software company and converted it into what is essentially a Bitcoin holding vehicle, who has issued debt, diluted equity, and structured financial instruments, all in the pursuit of accumulating as much Bitcoin as possible before what he believes is an inevitable historic repricing of the asset. While Strategy's stock was declining for 8 months, Saylor was not retreating. He was not hedging. He was not reassuring investors with careful, measured statements about risk management. He was buying more Bitcoin. And now, after those 8 months, the stock just delivered 32% in a single month. So the question that the market is now forcing into the open is this: was Schiff right, and this is just a temporary relief before the structural collapse he predicted? Or was Saylor right all along, and those 8 months were simply the accumulation phase before something much larger begins? Because here's the thing that makes this genuinely unsettling. Both of them cannot be right. One framework survives this moment, one gets invalidated, and we may be closer to finding out which one than most people realize. Now, here's the part nobody is paying attention to, and I want you to hold this thought as we go forward. What if this isn't really about price at all? What if this is actually about which belief system can survive sustained market pressure, and which one only works when the market is going up? That distinction is everything, and it's exactly what the next section. Let me give Peter Schiff a fair hearing. Because if you've only encountered his argument through social media clips or dismissive headlines, you haven't actually heard his argument. You've heard a version of it stripped of its real substance. And understanding his argument at its strongest is not just about being fair. It's about protecting yourself. Because if he's right, and I mean structurally right, not just timing right, then the 32% in April is one of the most dangerous things that could have happened, because it pulled people back in right before something much worse. So let's go through the 3 core pillars of his case. The first pillar is leverage risk, and this one is the foundation of everything else. Strategy has not accumulated Bitcoin by simply saving corporate cash and converting it. It has issued convertible notes. It has raised capital through at-the-market equity offerings. It has structured its balance sheet specifically to maximize Bitcoin exposure using debt as a tool. That means the company's financial obligations, the real ones, the ones that don't disappear when sentiment shifts, are fixed. They exist regardless of what Bitcoin's price does on any given day, week, or month. And the asset backing those obligations, Bitcoin, is famously, historically, structurally volatile. Schiff's point is not that Bitcoin will definitely go to zero. His point is that building a leveraged balance sheet on top of a volatile asset creates an amplification effect that works both ways. And on the downside, it can work faster and with more force than most investors are prepared for. The second pillar is dilution, and this is the one that hits closest to home for existing shareholders. Every time Strategy raises equity capital to buy more Bitcoin, the existing shareholders get diluted. More shares are created, more ownership is distributed, and unless Bitcoin appreciates at a pace that more than compensates for that dilution, shareholders are actually losing ground even when the stock looks like it's holding value. This is the silent cost. It doesn't show up as a loss on your brokerage statement, but it's happening every time a new share offering is announced, and the cumulative effect over years of aggressive accumulation is significant. The third pillar, and Schiff considers this the most structurally dangerous, is what he calls the dependency trap. Strategy's original business is enterprise software. That business generates revenue, but that revenue, relative to the scale of Bitcoin exposure the company has built, is essentially irrelevant. The company's financial survival, its ability to service its debt, its ability to maintain investor confidence, its ability to avoid a forced liquidation event, is almost entirely dependent on Bitcoin's price remaining at or above certain thresholds, which means there is no operational escape hatch. If Bitcoin fails, for whatever reason, the business underneath cannot absorb the damage. Now, and this is what I want you to sit with for a moment. Schiff is not just making a price prediction. He is making a structural argument. He is saying that the architecture itself contains fragility, and that fragility exists whether Bitcoin is at $40,000, $80,000, or $200,000. Because at some point, if the price corrects significantly enough, the leverage in the structure turns from amplifier to accelerant. And yet, the stock just returned 32% in a single month. Which means either the market has decided Schiff's structural concerns don't matter, or the market hasn't fully priced in what those structural concerns actually imply. Which one is it? That's what we need to figure out. Subscribe now if you want to stay ahead of what's coming, because this story is not finished, not even close. And the next chapters are going to move fast. While Schiff was making his structural argument, while the stock was bleeding for 8 months, while retail investors were exiting and short sellers were building positions, Michael Saylor did something that only makes complete sense if you understand the framework he is operating from. He purchased 3,273 Bitcoin, $255 million, deployed during a period when most investors were treating Bitcoin exposure as a liability, not cautiously, not incrementally, not with the kind of hedged, carefully messaged move that a company under scrutiny typically makes when its stock is in a sustained decline. With full conviction, maximum deployment, zero apology. and Strategy's total Bitcoin holdings now sit above 818,000 Bitcoin. That number is not a portfolio decision. That number is a civilizational bet. So why would someone do this? Why would someone continue accumulating aggressively, publicly, at scale during 8 consecutive months of market punishment? The answer is that Saylor is not operating on a quarterly timeline. He is not measuring success by what the stock does in any given month or year. He is operating on a thesis that spans a decade, possibly longer. His core argument, stated simply, is this. Bitcoin has a fixed supply of 21 million coins. That number is mathematically enforced. It cannot be changed by any government, any institution, or any central bank. It is the first asset in human history with a genuinely immutable, publicly verifiable scarcity. And as the global financial system continues expanding, as fiat currencies continue being debased through monetary expansion, the relative value of that scarce, immutable asset will increase. Not because of speculation, not because of hype cycles, but because of the fundamental mathematics of supply and demand applied to a store of value that cannot inflate. In that framework, every moment Bitcoin is trading below its eventual equilibrium price is an accumulation opportunity. Every dip is a discount. Every period of fear and selling is simply the market doing the work of separating short-term holders from long-term conviction capital. The 8 months of pain, in Saylor's worldview, were not a warning. They were a clearance event, and he used them accordingly. Now here is where things start to break down in an interesting way. And I want you to pay close attention to this. Saylor's thesis has worked before. This is not theoretical. In previous cycles, when strategy was written off, when the stock was down dramatically, when the critics were loudest, the market eventually turned and the holders who stayed came out on the other side with extraordinary gains. But here's the difference this time that deserves honest acknowledgement. The scale of this position is larger. The leverage embedded in the structure is deeper. The number of external variables, regulatory, macroeconomic, geopolitical, that can affect Bitcoin's price trajectory is greater than in any previous cycle, which means the potential upside, if Saylor is right, is genuinely extraordinary. And the potential downside, if Saylor is wrong, at this scale, with this leverage, is equally so. This is the volatility multiplier at its most extreme. And this is exactly where the story gets both exciting and uncomfortable at the same time. Comment below. Are you positioned in this space right now, or are you watching from the outside? I want to know where my audience is sitting on this. Be honest. Let's talk about what actually happened in April. Because the number, 32.57%, is attention-grabbing. But the mechanics behind it tell a story that is far more important than the number itself. To understand the move, you need to understand what was building during those 8 months of decline. When a high-profile, narrative-driven stock enters a sustained downtrend, it doesn't just attract sellers. It attracts a very specific kind of participant, the short seller. Short sellers borrow shares and sell them into the market, betting the price will continue lower so they can buy them back at a lower price and pocket the difference. And in a prolonged downtrend, especially in something as emotionally charged as a leveraged Bitcoin proxy, short positions can accumulate to significant levels. Because every new month of red candles validates the short thesis. Every piece of negative commentary from voices like Schiff adds to the confidence of the short sellers. Every retail investor exit creates more downward price pressure that reinforces the trade. So by the time you reach the end of 8 months of sustained decline, you have 2 overlapping forces pressing the price downward simultaneously. Genuine sellers, motivated by loss cutting, portfolio rebalancing, or loss of conviction, are still exiting. And short sellers, motivated by directional profit, are actively adding pressure on top of that. Both groups are selling. Both groups are pointing the chart lower. And critically, both groups eventually need to buy. The genuine sellers eventually run out of shares to sell. There's a finite number of people who want it out. And at some point, they are out. The motivated selling exhausts itself. The short sellers have a harder problem, because unlike the long side sellers who can simply walk away once they've exited, the short sellers cannot. They have an open obligation. And if the stock starts moving against them, their losses are theoretically unlimited. So when the stock begins to move higher, for any reason, short sellers face a moment of decision. Do they hold the position and absorb the loss, or do they close the trade by buying back the shares they borrowed? Most of them buy back, especially the ones with significant losses mounting. And when short sellers buy back their positions into a rising market, they don't just exit the trade. They become involuntary fuel. Their buying pushes the price higher, which triggers more short sellers to close their positions, which pushes the price higher still, which triggers more stops and margin calls, which accelerates the move further. This is the short squeeze. And April had all of its classic signatures. Now here's the part that smart money is already dissecting very carefully. A short squeeze and a fundamental trend reversal can look identical from the outside. The chart looks the same. The percentage looks the same. The media coverage looks the same. The social media energy looks the same. But the underlying cause, and more importantly, the sustainability of the move, is completely different. A genuine trend reversal means new buyers with conviction are entering. Long-term holders are adding. Institutional capital is rotating in with a fundamental thesis. The narrative has structurally shifted, and the new direction has legitimate support behind it. A short squeeze means the sellers temporarily ran out. The forced buying created a dramatic spike. But if real conviction buyers don't follow, if the genuine long-side capital doesn't show up behind the squeeze, the move fades, and the reversal that looked so decisive turns out to be a trap. Now here's what complicates the picture in an interesting way. Michael Saylor's purchase of 3,273 Bitcoin during this period, that was not short covering. That was not technical trading. That was not opportunistic momentum chasing. That was long-term conviction capital being deployed at scale, which means at least one major buyer with a genuine fundamental thesis was adding. Whether that is sufficient to sustain the move, or whether it represents one strong hand in a market that still needs more participants to confirm, is the question that the next several months will answer. Stay with me, because what comes next is the section that most people skip, and it's the one that actually determines whether any of this matters to your financial life. Now we're at the center of everything, and I'm going to be honest with you, because this channel is built on that. I cannot tell you with certainty who is right. Nobody can. Not yet. But what I can do, and what I think is genuinely more valuable than any prediction, is show you how the two frameworks actually resolve. What conditions validate Schiff? What conditions validate Saylor? And what signals to watch for, so you're not the last person to understand which way this is going. Let's start with Schiff's resolution path. Schiff's thesis resolves quickly, and it resolves decisively. If Bitcoin experiences a significant sustained decline from current levels, the leverage embedded in Strategy's balance sheet begins amplifying the downside. Debt service becomes a concern. Investor confidence deteriorates. The stock corrects sharply. Short sellers return. The structural fragility he has been warning about becomes visible to everyone, not just the people who were paying close attention. And in that scenario, the 32% in April becomes a data point that is studied for years as the classic relief rally before the final leg down, the moment that pulled people back in right before the collapse Schiff predicted. His framework gets validated. His credibility, after years of being dismissed, gets restored. Now Saylor's resolution path. It resolves slowly, and it requires patience that most investors and most market observers, frankly, do not have. For Saylor to be proven right, Bitcoin needs to build on its current momentum with sustained institutional adoption. It needs regulatory clarity in major economies to continue progressing. It needs the global macro environment, the ongoing expansion of fiat money supply, the questions around sovereign debt sustainability, the search for alternative stores of value, to continue pushing sophisticated capital toward Bitcoin as a reserve asset. And it needs time, not months, years. Saylor has said explicitly, many times, that his thesis is a decade-long arc. He is not optimizing for the next quarter. He is positioning for what he believes is an inevitable repricing of Bitcoin relative to every other store of value on the planet, which means the 32% in April, in his framework, is not the climax of the story. It is barely the beginning. Now here is the genuinely difficult thing about these two frameworks. Both have been partially right at different moments in the last several years. Schiff was right about the downside risk during the 8-month decline. Saylor was right about the upside potential during every previous bull cycle. But being right in a phase of a cycle and being right in the final conclusion are two completely different things. And the timeline asymmetry between the two frameworks is the most underappreciated risk in this entire story. Schiff's nightmare scenario can play out in weeks. Saylor's vindication requires years. Which means if you're on the wrong side of this at the wrong moment, the market does not give you time to wait for your thesis to be proven correct. If you've been watching for a while and this is starting to click, if the bigger picture is finally coming into focus, drop the word clarity in the comments right now. I read every single one, and it helps me understand how deep this audience is actually tracking. This is where things get genuinely uncomfortable. And I want to be careful here, because this section is not about picking a side. This is about understanding a mathematical reality that exists independently of ideology. It doesn't care whether you're a Schiff believer or a Saylor follower. It operates the same way regardless of your thesis. Strategy does not track Bitcoin, it amplifies Bitcoin. And most investors, including many experienced ones, have not fully internalized what that means in both directions. Here's the mechanics of it, explained simply. When a company uses debt to purchase an asset, the equity of that company does not move one for one with the asset. It moves at a multiple. The reason is straightforward. The debt is fixed. It doesn't fluctuate with the asset price. So when the asset goes up, all of the gain above the debt level flows directly to the equity holders. The equity captures more than the asset's percentage gain because the leverage amplifies the move upward. This is exactly how you get a 32% monthly return in the stock during a period when Bitcoin's own move, while significant, was not 32%. The leverage did the amplification work. But here's the part that requires you to sit with it. That same leverage amplifies the downside with equal force, and in conditions of severe stress with greater speed. A meaningful Bitcoin correction does not translate to an equivalent correction in strategy's equity. It translates to a decline that is significantly larger because the fixed debt remains while the asset value below it shrinks. And the closer the asset value gets to the debt level, the more dangerous each incremental move becomes. At extreme stress levels, and this is what Schiff is pointing at when he talks about structural fragility, the company could face situations where it needs to service obligations it cannot comfortably service, where access to capital markets becomes restricted, where the very act of trying to de-risk accelerates the problems. This is not a theoretical concern. This is the mathematics of leverage under stress. And the critical point is this: Saylor's thesis can be directionally correct. Bitcoin can be a superior long-term store of value. The 21 million coin supply ceiling can be exactly as powerful as he believes. And in the short to medium term, if the price moves against the position at the wrong moment with the wrong magnitude at a time when debt obligations are pressing, the structure faces severe stress regardless of whether the long-term thesis is valid. Conviction does not restructure a balance sheet. Belief does not service debt. The volatility multiplier is completely indifferent to ideology. So when people ask, what happens on the next major Bitcoin move? This is exactly why that question matters more than almost any other question in this story right now. Share this with someone who needs to understand this before they make a decision based on the 32% headline, because the headline and the structure underneath it are two very different conversations. So let's bring it back to where this all started. This might be the most dangerous turning point after 8 months of pain. I chose that word deliberately at the top of this video. Dangerous, not exciting, not historic, not the beginning of something extraordinary. At least not yet. Dangerous. Because a turning point is only a turning point when it's confirmed. And confirmation doesn't arrive in the month it happens. It arrives months later, when you look back and can see clearly whether the reversal held or whether it was the last moment of relief before the real reckoning. Right now, we are inside the moment. And the people who have come out of turning points like this on the right side throughout financial history are not the ones who were most confident about the direction. They were the ones who understood the structure clearly enough to make a deliberate decision, rather than an emotional one. So here is what this moment actually is, broken down as honestly as I can frame it. The price action in April was real. 32.57% is not a fabricated number. The short squeeze dynamics were real. The Saylor purchase was real. The exhaustion of motivated sellers was real. These are legitimate signals that something shifted in the technical and sentiment landscape. At the same time, the structural concerns Schiff has raised are real. The leverage is real. The dilution is real. The Bitcoin dependency is real. These don't disappear because April was a good month. And here's the most honest statement I can make about where we stand right now. Both the bull case and the bear case have genuine substance. The market, in April, voted for the bull case, decisively and dramatically. But markets have voted wrong at turning points before, and they have voted right at turning points before. The difference between those two outcomes is almost never visible in the month it happens, which is exactly what makes this moment, right now, either the beginning of something remarkable or the most dangerous place to be caught leaning in the wrong direction. The ideology war between Schiff and Saylor is not resolving today. It is intensifying. And the next major move, in Bitcoin, in the broader macro environment, and institutional positioning, will tell us far more about who is actually right than anything either of them has said publicly. Watch this space carefully, because the answer is coming, and it will arrive faster than most people expect. So let's land this. 2 men, 2 frameworks, 1 market, and only 1 outcome. If Peter Schiff is right, the 32% was a gift, a final liquidity event disguised as a recovery, a moment where the market gave cautious investors one last exit at a favorable price, before the structural fragility he has spent years warning about finally becomes impossible to ignore. In that world, the people who read the relief rally as confirmation of a trend reversal will feel it. If Michael Saylor is right, those 8 months of pain were the price of admission to what comes next. The retail exits cleared the path. The short squeeze initiated the reversal, and the Bitcoin accumulation happening at scale during the decline positioned the right people for an expansion that most observers still haven't priced in. In that world, the people who understood the thesis and held through the pain will look back on this turning point as the moment everything changed. And the truth, the uncomfortable, honest truth, is that right now, at this precise moment, the market has not told us definitively which world we're in. We are at the inflection point. The price data says reversal. The structure says fragility still exists. The Saylor purchase says conviction is real. The Schiff argument says conviction is not sufficient protection against leverage risk. All of those things are simultaneously true, and the people who will navigate this correctly, regardless of which direction it ultimately resolves, are not the ones waiting for certainty before they move. Certainty is always priced in before you can act on it. The people who come out ahead are the ones who understand both possibilities clearly, who have thought through what they would do in each scenario, who have made deliberate, informed decisions about their position rather than reacting emotionally to each new headline. That is what the wealth continuum is here for. Not to tell you what to think, but to give you the framework to think clearly before the moment has already passed you by. If this video gave you that kind of clarity, if the picture finally clicked, subscribe, because what comes next in this story is going to move fast. And this channel exists for the people who want to understand it before it becomes obvious to everyone else. Drop the word clarity in the comments if this landed for you. I read every single one, and it matters to me to know who is tracking this at the level this story deserves. And one more thing, tell me what you want me to break down next. The next Bitcoin cycle, the macro conditions building underneath all of this, the institutional money flow that nobody is talking about openly. The next video comes from you. What would you do if this plays out the way Saylor expects? Are you positioned, or are you still watching? Because this turning point, whatever it turns out to be, is not going to wait for you to decide. The wealth continuum, think early, stay informed, position deliberately.